Trades on the New York Stock Exchange American, ATCH, seeks to build a cutting-edge, technology-enabled financial services firm, and through proposed acquisitions will have the capabilities to deliver a complete and modern platform with the potential to give their prospective clients flexibility, speed, risk management capabilities, and scale they need to grow. Please welcome President Craig Ridenhour and Chairman and CEO John Schaible. Welcome to the conference, gentlemen. Happy to see you again.
Thank you for having us, Anna.
All right, Craig, start us off. Please take a moment to remind our audience the history of AtlasClear and what is your mission?
Great. I appreciate the opportunity. Yeah, as a refresher, we'll give a brief history of AtlasClear. I think as most that may be viewing this right now know, we went through, AtlasClear came to be through the de-SPAC process. So we went through a de-SPAC transaction. We closed the transaction February 9th of last year, 2024. We started trading publicly as ATCH February 12th. And there was a good and bad of that, let's just be honest. The good part of the SPAC transaction was it got us public and it allowed us to acquire some incredibly valuable assets, we believe. The bad part of it is all the things that go through the de-SPAC and all the cholesterol, we call it, that's associated with it, that we had to take on convertible debt, that we had to do a number of things to get the transaction done. So although we got public, we acquired some incredible assets, we did get this cholesterol that, quite frankly, we couldn't predict in most situations. We had no idea the impact and what would happen and really transpire over the last year. We certainly, unfortunately, learned lessons now, but we are in a position where we now have an incredibly valuable asset in Wilson Davis. We're obviously going to speak a little bit about the quarterly numbers. It continues to grow and expand. We think it's got a bright future. In Wilson Davis, we had targeted it some time ago. John and I have been looking at it for some time because Wilson Davis is a full member at NYSE. What that means is that's a very limited pool. That is similar to Pershing or Fidelity. They're full members at NYSE. They've got a really unique licensing set. But in their history, and this is to give a little more history to the audience, Wilson Davis had primarily focused their business on the microcap, almost exclusively the microcap market. That's what they're known for. And they've been done incredibly well. It's an incredibly profitable business, but that's been what their history's been built on. But when you're a full member at NYSE, you have so many other lines of business. Just start with margin lending, stock loan, eventually portfolio margin, all these other lines of business that you utilize, and they really weren't doing at the time. But when we looked at it, we said, if we can acquire this asset and this incredible company has unlocked potential, then we really could capitalize with the right capital base in it. So again, it allowed us to acquire that asset. Also at close, we also acquired a technology stack that we will implement over time as we expand the enterprise and get certain other assets in place. And then we also attached to this is we have a follow-on transaction for the acquisition of Commercial Bank Corp, which is a small Fed member bank out of Wyoming, over a 100-year-old charter, clean, profitable, has a lot of opportunity for us. So we're excited about where we are. Unfortunately, we had to go through the de-SPAC process. Well, what this allows us to do by bringing these pieces together is it allows us to create a one-stop solution from a clearing and settlement of securities transactions for our clients to banking opportunities, to extending credit, to doing a number of other things just to create a full technology platform for them so that they can go in and manage their clients' assets. And when I say our clients, I'm talking about our target market is small institutions. So small broker-dealers, small family offices, small hedge funds, all of these institutions that can be fairly large in size. It could be a billion in revenue or less, but they have trouble getting into the larger clearing firms like Pershing. There's obstacles there. And so they're orphaned. So what they have to do in this marketplace right now is they have to go out and they have to piggyback with other institutions that may have direct clearing into Pershing. What happens is when they piggyback, obviously to get that, they have to give up some of their own margins. They have to give up potential credit extension, things that they really would help generate more business for themselves and help manage their clients' assets. They have to give up a little bit in order to get clearing for these assets. And the other side of it is they might have to go through multiple intermediaries. And if you're a small broker dealer, you have to go through multiple intermediaries to get one intermediary, meaning clears your equity transactions. The other intermediary may clear your fixed income. At the end of the month, you have to consolidate everything down into a single monthly statement. It's a nightmare. So what we're proposing in our mission long-term is with this platform to interlink the clearing of Wilson Davis, with ultimately provided we get a successful approval of commercial bank work, which we're optimistic we will, and then layer in technology and create a one-stop solution and full suite that we can offer to the small institution space that's really underserved and almost been orphaned. We think we've got a huge opportunity to capitalize. So that's kind of the history and the mission. And we think we're well on our way. We've got obstacles, obviously, but we're excited.
Wonderful. Thank you, Craig. John, for you, you recently released quarterly numbers. So take a few moments, give us an overview of the numbers and how management felt about the quarter overall.
Sure, and I'm happy to do that, and thanks again. I want to begin by pointing out that the Q that we filed is a little bit skewed because since we de-SPAC'd in early February of last year, the Q over Q comparisons do not measure the same number of days. This is best described in the Q that we filed. I want to make sure that everyone understands that and can go look at that Q to make sure they understand the number of days that were counted. But as reported, revenues quarter over quarter, March 31, 2025, this year were 2.54 million. Last year was approximately 1.2 million. So there was a revenue increase. I think more importantly was the loss from operations. Last year, we lost 13.8 million in the first quarter. We brought that down by about 92% to where our loss was 1,072,000 this year. At the consolidated level, the expenses last quarter were 15.1 million. This year, we dropped it down by 76% to 3.6 million. And so the process of managing the financials, I think, have improved dramatically. We bought a brokerage firm that Craig mentioned, Wilson Davis. We think it's a great target. At that target level, standalone, non-GAAP, we again had higher revenues and we increased net income by a good multiple, which was a result of the higher revenues and also the reduced expenses. I think the most compelling, sorry, someone's at my house and the dog is barking. I think the most compelling progress was made on our balance sheet, as stated in the Q. When you look at the stockholders deficit from the year end last year, and we report on a June 30th year end, our stockholders deficit was about 38 million. We have reduced that deficit by 24 million down to 13.9 million. And so for the quarter, our balance sheet has improved with respect to total debt. Since de-SPAC, we've paid off over 15.5, well, just shy of 15.5 million of the convertible debt taken on during de-SPAC. And so this quarter, bottom line, revenues are up, expenses are down, our debt levels are way down, and so we're pretty happy with how the quarter has unfolded.
Well, good. So you are satisfied with your quarter over quarter performance?
Yes and no. I mean, we limped so badly out of the de-SPAC process. We were so undercapitalized, and what we hoped we'd have this budget to go out and market properly, to increase the net capital of the brokerage firm, to accelerate stock loan revenues faster. We really only took $675,000 out of the trust de-SPAC, and that very much hamstrung us from the beginning. Had we been properly capitalized, we would have begun stock loan sooner. We would have been marketing to more introducing brokers harder, and I believe we could have increased revenues dramatically from what we actually did. Even though the revenues are up and the net income is up significantly, I think it could have been better. So in that respect, I'm not satisfied. But with respect to the hand that was dealt to us coming out of the de-SPAC, we bought a gem of a company. It is excellently staffed. The team is deeply experienced. And through having a good team, we've been able to make improvements in spite of the baggage from the de-SPAC and in spite of not having the adequate capital. So I'm not happy or satisfied compared to where we thought we could be or should have been with the right amount of money. I'm very happy with how the team has responded.
Perfect, John. Thank you. So, Craig, let's talk about some of the parts of the business that are working best. What are they?
Sure, Anna. Sorry about that. I didn't mean to so I didn't have any background noise. There are a number of avenues right now and business lines that are working for us. One, obviously, we're still in the microcap and certificate business. We're one of the few out there that do it. And that is a very highly profitable business. If you have the right AML, KYC, the risk management protocols in, and just to explain to people, maybe a lot of people understand Wilson Davis, maybe people understand that business, but if you're a small cap company and you go public, you may create certificates, right? There are a lot of companies still out there that have certificates. There are very few companies that will take these smaller price securities in on those certificates and put them in book entry form and then put them in to allow them into the public markets. Wilson Davis is specialized in. We are going to continue that business. It continues to grow. It's highly profitable. And we believe we have great AML, KYC, risk management protocols in place to review chain of custody all the way through all the documents to make sure that security is cleared, and we put it in and we can perform, we can allow executions on those. So that's a very good line of business. We're going to continue that. We're going to expand our investment banking. That's one of the lines of business Wilson Davis up until last year had never utilized. But we have a real opportunity as a clearing firm to do investment banking. We did a couple of deals last year. We have a number of deals that we're working on right now. It's the diligence stage. But we have an opportunity to go out and really expand investment banking, because when you look at it, as we expand our company and as we expand our correspondent line, which means other introducing broker dealers, as we have investment banking deals that we feel comfortable, that we feel are good deals, that we feel are properly managed companies, and we want to bring them in and actually take to the public or capitalize, could be a number of other things. We want to have the ability to actually present that out to our client base, because we do have a captured group of clients. So we want to add value there. So we see investment banking really expanding. And I will tell you that over time, we want to create a structure where not only do we have investment banking as one of the cores, but also we want to create a structure internal at Wilson Davis where we can present investment banking opportunities out to our own internal client base, which we aren't utilizing right now. And there's certain compliance things we have to put in place, and there's a number of regulatory measures, but it's there. We can grow that, and it is growing right now. So we're excited about investment banking. And then, as John just mentioned, we really just started to take up stock loan. I mentioned that's one of the things we identified with Wilson Davis. An interesting thing on stock loan and why we think we can be so successful at Wilson Davis is that they had never really used stock loan. Okay, so when we were going through the acquisition, again, we put February of 24, but in 2023, we wanted to take a look at the book of business that was at Wilson Davis. And by that, we hired a third-party independent company to come in, do an evaluation, and analyze the hard-to-borrow book of assets that Wilson Davis has. That means securities that are held at Wilson Davis for clients that are hard to borrow on the street, because it's highly profitable business. Because we want to say, okay, what is the untapped potential here? And we were shocked to find out. Okay, keep in mind our revenues, right? Last year we did 13 million at Wilson Davis in 2024, about 13.3 million top line revenue. But we come to find out in 2023 that had they used stock loan and offered that out to our borrower, they were leaving 13 to 14 million dollars on the table. So that's the reason we're so confident there's such a great opportunity in stock loan, and we'll expand that as we expand our client base. And as just to mention, we put out a couple of press releases in the last couple of months. One, we had signed an agreement with a technology called Lockbox. Lockbox is specifically designed for stock loan and pre-borrow market. We think it'll help us really create efficiencies in our ability to expand that business. And then we also brought on a gentleman to lead our stock loan efforts named Todd Tobacco. Is pretty well known on the street. We're excited to have him. He really just started to kick off in April. We're very pleased with the progress already. Expansion on stock loan. So those are two of the lines that we think are doing really well right now, but I think they're going to do in the future.
Wonderful. Well, you touched on this, so talk a little bit more about how you accelerate and grow the business going forward.
Sure. We accelerate and grow. Well, first and foremost, we want to put more capital in Wilson Davis. We need to. Okay. What that will allow us to do is it will allow us to go out and organically capture more clients. Okay. And by that, again, I wanted to state our client base that we want to target are institutions, small broker dealers, family offices with a larger capital base. We'll be able to organically go out there, okay, and grow that base through our capital, all right, and through our client base and leveraging relationships we already have internal to our system. So we're going to go out and do that, and we think we'll be very successful because the market really is desperate for our solution that we think we'll create. So that's one way, right? A second way is really to bring more value to the clients that we serve. And by that, I mean is with better technology, increased profit offerings. That can be investment banking opportunities. That can be down the line digital asset offerings. It can be a number of things, but it's creating value for them to present to their clients, right? To determine if it makes sense for them or not. as they're able to offer more to their clients, it can increase their revenue streams, increase the efficiencies in their clients' portfolios, and if they succeed, we succeed. So we think we've got a real opportunity there as well. The third way that we can do it is the international market. The international market has extreme challenges, unless you're one of the major institutions out there. But the smaller international market, smaller broker-dealers offshore, even medium-sized, sometimes can't get clearing into the U.S. And by that, I mean, if you want to trade in U.S. assets, you have to have a relationship with an SEC DTC member, which of course we are. So we've got some experience offshore. A number of members on our team do. We think that we can offer, again, the AtlasClear solution offshore with the proper AML, KYC, and risk management. And we really have an opportunity to capitalize on the international market. Now, I will tell you that right now we're solely focused on getting the capital in and starting to grow the domestic business. But over time, we see a real opportunity in the international market because there's only a few institutions out there that really offer full clearing offshore, and especially in certain jurisdictions in the world. And so we think that we can be incredibly successful there long term. And we think there's an opportunity near term. We are going to focus domestically, though. I do want to clarify that. Just make sure everyone understands there's plenty for us to do here. And then the fourth thing that we can do is that we can actually go out and we're going to look at targeted acquisitions. Now, I realize where our stock price is. And to look at targeted acquisitions right now, you know, we're not looking to target acquisitions at this moment because, quite frankly, our stock's depressed. We think it's undervalued. People can have a disagreement with that. But we do have public currency. And our ideal has always been not only to grow organically, as I just mentioned before, but also to grow through targeted acquisitions that would allow us to go out and buy companies that are accretive in revenues, but also in technology. They bring technology value to our platform so we can expand our offering there. We also have an idea. We want to go out and acquire introducing broker-dealers that will introduce right back into Wilson Davis. We've got an idea of moving some of our retail that's on Wilson Davis over into, you know, an introducing broker-dealer that we could acquire that'll just introduce back into Wilson Davis, right? So that the clearing arm will just focus on clearing. We'll have the retail arm over here. So we've got an entire strategy. We've got, you know, we believe capital solutions coming in. We think our stock price over time will become a real value to us because that'll allow us to go out and acquire. So there's a number of ways that we can grow this. And then finally, I'd be remiss if I didn't say, we do see the wave coming. I think everyone should, regardless of which side of the aisle on. There was a change in the presidential administration. You know, people talk about crypto. We don't like to call it crypto. We believe in DLT, distributed ledger technology, blockchain, what it's built on will ultimately be where everything settles over time. We have an administration that's embracing that, an SEC that appears it's going to embrace that. We have always talked in the past, Anna, that we will be in that marketplace, but we won't put the cart before the horse, right? We won't do it before SEC guidelines and regulations and guidance because that just didn't make sense to us. But we believe that is coming, and we believe with the technology that we have, ultimately, but the licensing set with Wilson Davis, and should we be successful with the acquisition of Commercial Bancorp, the licensing that we will have with the Fed member bank, it really opens up the world for us to be able to provide that type of platform, solutions, product to our client base, and especially the small institutions that will want to be in that space but may not be able to get access, and we think we'll be able to present that. So we've got some long-term opportunities to grow this, and I think that I think we're on our way. We just gotta clean some things up on the capital side, and I think we're going to.
Fantastic. Well, thank you, Craig. I've got a few questions for you, John. First, where do you stand with the acquisition of Commercial Bancorp?
And we're not as far along as we hope we would be. As Craig mentioned, Commercial Bancorp is another gem. It is a Fed member bank. It's over 100 years old. It's profitable. It's clean. It's well run. But much like we saw with Wilson Davis, we see it as underdeveloped, and we see a lot of potential to increase revenues. We really believe we can do a lot more after we've acquired it and attached it to a clearing company. Specifically with the bank, we know we can enhance materially the net interest margin that both the clearing firm recognizes and the bank recognizes. Through the bank, we can kickstart crypto custody. We can kickstart crypto lending. There are so many things we can do with the bank once it's acquired. We're kind of frustrated that we haven't made the progress that we wanted to. And we haven't made the progress because we limped out of de-SPAC without enough capital. We haven't been able to push forward on the bank acquisition because we have not had the money to get it done. We have announced an investment deal with a company called Ridenhour LLC. We think that is shortly coming. If that fulfills, it will allow us to accelerate the acquisition. But where we stand today, we're not as far along as we'd like to be.
Can you talk a little bit about what that timeline looks like for the acquisition?
Sure. From funding, assuming we have the capital necessary to pursue the regulatory process and buy the bank, we anticipate it'll be between 12 months and 16 months, depending on what the Federal Reserve requires.
And so your stock price is down over 99% from de-SPAC. So what went wrong there?
How much time do we have left? Nine minutes? We could be at this for a long time because a lot went wrong. And a lot of it had to do with the timing of when we de-SPAC'd. We chose to do the SPAC because we had identified in our private companies a number of acquisitions that we thought were really good. But COVID hit, and we didn't really have a way to trust what the revenues would be from the acquisitions. And so we decided to do the acquisitions from the SPAC, and we went public in February of 2021. And at that time, getting money into a SPAC was pretty easy, right? What we didn't really recognize at the time, because SPACs hadn't been failing, is what the investor's motive was from coming in trust. We offered them a safe haven where they could come in, they could park their money, they'd get treasury yields, they would have the opportunity to take the warrant and create for themselves optionality. And we've heard this term SPAC mafia, and while I don't know mafia is necessarily appropriate, but really what developed is this ecosystem of investors that like the treasury yield, like the optionality, and really had no intention of investing in the deal. And that is really what we found out. Also at that time, the underwriting structures, SPACs back then didn't really fail. Most SPACs, especially in the SPAC craze, had relatively low levels of redemptions. And so the way the underwriting agreements worked, the underwriter would raise money, they get paid for that, they'd get paid for the de-SPAC. But for us, we didn't benefit from those redemption levels. We only got $675,000 out of trust out of the original $201 million we raised. And so what we ended up having to do was pay our investment banker many multiples of the amount of capital that was actually raised for us. And those multiples came in the form of convertible notes, which of course can dilute the stock and put pressure for us. Timing was further bad for us because we got in when we went IPO, the market was very hot, but then it went really, really cold. And it went cold for a couple of reasons. One of the big reasons was the change in the administration, the change in the SEC leadership, but also the SPAC market did in fact propagate some deals that maybe it shouldn't have. And so the regulatory environment went from open and fast to cold and closed and very expensive. So that process really created a freeze for us. And our SPAC in particular paid a pretty heavy price because prior to doing the AtlasClear deal, we had put together another deal to acquire a company called TradeStation. And the TradeStation deal was a $1.2 billion deal. We had also built a $125 million pipe. But after we filed the S1, we were frustrated because the SEC, with the chill, and again, this is management opinion, I'm not saying this is fact, with the chill, it really seemed like any company that touched crypto at that time was not going to go anywhere. And TradeStation at the time had generated a small portion of its revenue from crypto activity. And so we were going back and forth with the SEC on the S1 filings and amendments. And every filing we put forward, we got back more questions about crypto. And unfortunately, TradeStation ultimately made the decision that they didn't think we would ever get through that SEC leadership, and so the deal got pulled away. The AtlasClear deal is a great deal. It's a fantastic deal. The asset we bought, we think, is going to be hugely valuable, but it was only $25 million. And so what ended up happening to us is that our SPAC inherited the costs of two transactions, one of which was very large and very expensive, on a scale that probably wasn't best to support it. And then coming out of the de-SPAC, we had to, again, we only got $675,000. We were buying a company worth $25 million. That delta of about $24.3 million was made up in the form of convertible notes that were dilutive, that had not the best floor structures. And so all of these things put us in a position where we had to move as fast as we could to get the stock registered for those convertible notes as quickly as we could. And each of those convertible notes had penalty provisions. But because we were still unable to move timely through the regulatory process, we ended up inheriting an additional 5 million plus in convertible notes just from penalty provisions attached to the convertible note structures. And so in sum, what went wrong was that our timing was terrible, right? We ended up getting much less capital than we expected. We ended up with much more debt, and we ended up with much more potential dilution. And that is reflected in the stock today. But I don't want to paint it as dismal. There are a number of things that went right. Craig and I will continue to scream from the mountaintop that the company that we bought is a great company. It's growing, it's profitable. We also built the right vendor relationships. As a public company, you really have to make sure your queues are on time, your audits are right, all of the things you need to do. And our lawyers, which are Greenberg, internal CPA, Calabrese, auditors, Haney, our printers, Topin Merrill, they have been so incredibly supportive and so efficient. We know that going forward, we're well protected to make sure that our public company status stays intact. So we are well supported. We bought a growing business. Our balance sheet, as I mentioned earlier, has improved dramatically. And then finally, I guess, one more thing that I hope the listeners view as an opportunity, as a good thing. Yesterday, our market cap at close was about $4.2 million, and that remains literally less than half of the net capital at the broker-dealer we own, operate, that is growing and profitable. So bottom line, what went wrong is timing is not everything, but critical, and our timing was bad. And I think today we represent incredible value.
Wonderful. Thank you, John, for that. A few more questions with the time we have. You recently changed transfer agents. So can you tell us why the change was made?
Yes, I'm happy to do that, Anna. Great question. When we signed up for the de-SPAC and for the SPAC process, we signed on with Continental Stock Trust and Transfer. Our thought process coming into the SPAC was, get the best lawyers, Greenberg, get the best transfer agent. We were told that Continental Stock Trust and Transfer was the gold standard. And we worked with them for a number of years, and I can tell you they are the gold standard. But the way we came out of the de-SPAC, we came out, we're in a street fight, right? We've got to make sure we get the capital in. We need flexibility. We need lower costs. And so we began searching diligently for a different transfer agent that perhaps would be faster and more flexible, and more importantly for us, would be more cost effective. We moved over to a company called Dynamic Stock Transfer, and they've been absolutely fantastic. They are more cost effective, and they're very focused on customer service. Not to demean Continental Stock Trust and Transfer at all. They're great. They're probably great for Tesla or bigger firms. For us, in our street fight, Dynamic is the right partner. Perfect.
And what about concerns about being delisted? Can you address that?
Sure, absolutely. And this is a question we get regularly, so it's not one that we're not familiar with. I mean, anytime your price is where we are, 22, whatever it is right now, you get concerned. We're obviously concerned. We're mindful of it, I should say. We understand the NYSE American listing standards. We understand timeframes. We understand a number of these things. So we're mindful of it. But that being said, we believe we have solutions. One in Ridenhour, we do believe they're going to fund. We understand the delays, and they're process oriented on their side, but we're kind of right at the goal line. We're confident that money's coming. It's not here yet, so we can't speak to it, but we believe that'll come. Should that come, we believe that's going to be well received by the market because they are a true partner. They're looking at this over the next 10, 15 years. Once their full funding comes in, they'll actually have 2 board seats. So they're side by side. They're looking at this as a long-term investment. But what we think will happen is that the street will recognize that we'll be able to clean up our balance sheet, put additional capital into Wilson Davis, be able to start the commercial bank core application process in earnest. We think it'll be well received. We think that we won't be at risk of delisting for much longer. But I'd be remiss if I didn't say that if for some reason Ridenhour didn't happen, we have backup financial solutions. It's just Ridenhour is the best of those. They're truly structured in a partner manner. So we're excited about it. Yes, we are mindful of it, but and certainly you can be somewhat concerned, but we don't think it's going to be an issue for longer.
Last question. Has management considered a buyback of any sort?
Yes, we have. In short, provided we can clear up the convertible notes and we get the adequate financing, I don't think there's a better investment on the street than our stock.
Perfect. All right, gentlemen. Well, I want to give you 30 seconds to close. We've got a lot of questions, but we'll send them to you so you can answer on your own. So Craig, John, whoever would like to close.
I guess I'll close. Anna, thank you so much for the time. We'd like to thank Emerging Growth for the time as well. We are excited about where we stand. We do ask everyone to look at the company, look at the net capital inside the brokerage firm, look at the growth, look at the management team, look at where we were from DSPAC, from a valuation perspective to where we are today. And you should consider investing in our company because I think the stock is going to go higher. I don't know how to sing that louder, but that would be the message that I want to convey.
Wonderful. All right, John, Craig, thank you so much. And we look forward to talking with you again real soon.
Thank you.
Thank you.
All right, we'll be right back.